This coming week has a This week has a raft of big data points coming out across the board pretty much, but certainly there's going to be a predominant focus on the US when it comes to the jobs report that we see on Tuesday alongside the inflation figures on Thursday from a CPI perspective. Of course, we're coming off the heels of an FOMC meeting where we already saw a rate cut, but markets do expect more. And so the question mark here is, how are we going to see these data points impact the likes of the dollar, the likes of gold, and the likes of US equities going forward? As we see here, by and large, markets are going to be focusing on these 2 days, right? So it's the jobs reports for November and October coming out on Tuesday with an expectation of a reading of 10K and 55K respectively. Of course, alongside that, you're going to see other data like average hourly earnings and the unemployment rate. And then on Thursday, the inflation data with a perception we'll see a 0.2 figure on the core for the month, 0.3 for the monthly headline number. And hopefully we can soon start to get some downward trajectories for the CPI numbers, which are at 3%. So let's just quickly look through a handful of different charts and see exactly where we stand on these things. And then we can try and look at things from a sort of market impact perspective. So here we have the inflation figures. We've got the headline CPI number and the core PCE numbers. You can see the CPI number elevated at 3%. And really, we've been seeing some troubles rearing their head recently because the last 2 months that we've seen for August and September, we have seen elevated monthly CPI numbers. That hasn't been the case for core PCE. So core PCE under control, the CPI less so. It's at 3%. You can see that we're likely to see some disinflation in the coming months because if you look back at the left-hand side of the middle section, we've got some pretty chunky prints in green that are going to be stripped out, most notably November, December, and January. When they're stripped out and they're replaced, ideally with lower figures, then you see disinflation coming into play for the year-on-year figure for the so-called base effects. The 6-month annualized, though, does point towards the fact that recent inflation figures on the CPI front don't necessarily do us any favors and put the annualized 6-month reading. So if you just took the last 6 months and you extrapolated that at the pace at which it's going and what that would look like for a year's figure, you can see it's at 3.62%. So inflation on the CPI side of things is more problematic. And certainly you can see that here because the orange line, which is the core PCE, significantly lower than some of the recent CPI numbers. And so there is a perception that perhaps if we're going to see some problems show up, it's going to be on this side of the equation, on the CPI side of things. Now, notably, if we look in here, you can see that there is a relationship here between the prices paid element of both the ISM manufacturing and services PMIs and some of the CPI numbers. Now, what I've done here is I've put 3 different ways of looking at the CPI. So you have the year-on-year figure, which is the one that everyone sort of talks about, 3%. Then you have the 3-month annualized and the 6-month annualized. Now, essentially, that means if you take 3 months and you say, what pace is that going at and what is it consistent with? And then you look at the 6 months. So the 3-month, of course, would be the first one to move if we see a resurgence in price pressures over the near term. And it's going to take quite a while for that to show up in the year-on-year figures. So if you look back in the past, that's typically what happens. You'll see the sort of 3-month annualized figure turning upwards and the year-on-year figure more slowly doing so. Very similar to the kind of thing that you'll see with a 200 SMA versus 20 SMA. The 20 SMA will react to near-term price action much quicker than the 200 would. It's the similar kind of way of thinking. So you can see here that by and large, the 3-month annualized has been sort of rotating, but not necessarily breaking towards the upside. The caveat here is that if you look at a 6-month lag for those prices paid elements within the ISM numbers, that typically sort of shows a relationship between what the purchasing managers are seeing and what ends up being charged to consumers. And that lag shows that we did see a surge being faced by purchasing managers in the past, and that hasn't necessarily shown up in CPI yet. Maybe it doesn't, right? Maybe that experience from those purchasing managers, it just doesn't actually equate to anything. Maybe they ultimately write those costs off and see lower margins. Maybe it was a short-term phenomenon. But certainly notable that if you're looking at those two elevated lines, the services sector in particular, we've seen relatively elevated readings for the prices paid element. So do we finally start to see that surge coming into play for US inflation? That's one question. The next part of it is around the jobs data. We've seen weak data coming out from the ADP perspective, but we haven't seen much with regards to the headline numbers. Are we going to see further weakness? So if we see inflation rearing its head, that's negative for the dollar. That could point towards a patient approach from the Federal Reserve in 2026. If we see it under control and we see weakness in terms of the jobs market, then that points in the opposite direction, a potential for weakness in terms of the likes of the US dollar and the idea that we're going to see additional easing. So how are things going to shape up? Well, it's notable that whilst we have seen a rebound over the last monthly figure, by and large, the trajectory has been downwards in terms of the non-farm payrolls figures. And in actual fact, we've seen many of the more recent figures that look better than the ones before always revised down. So look at that last payrolls figure. We could see a healthy downward revision to that, much like what we've seen in the past. Also notable, of course, with the US government shutdown, we're going to be looking for any jitters around the government roles within this headline report that you wouldn't necessarily see within the ADP reports. The latest FOMC meeting actually saw a few key things. One thing was that Jerome Powell said that he thought that the US may, by their statistical methods, be overstating job numbers. So the jobs data could actually be worse than expected. So what happens is you see the initial number doesn't look too bad. Then you see a downward revision, and sometimes it will take you into negative territory. And then everyone thinks it's not great at all. And then all of a sudden you see actually Jay Powell is saying they could be overstating it by as much as 60,000 per month, right? And so this is a chart from Reuters, which essentially shows you what the recent figures would look like if that 60K was wiped off. Now, bear in mind, the latest reading on the right doesn't look too bad, even when you take the 60K off. It's not great, but still in positive territory. But that figure is prone to a downward revision, much like the figures on the left-hand side of this chart we have already seen. So the Fed know that the jobs market is weak, and in actual fact think it's weaker than we have all been seeing. Watch out for previous revisions. Bear in mind that any numbers are going to be viewed through the prism of, will they get revised down the line? And also, are they even being overstated when we do see the downward revision? Certainly, that's going to be a key thing to be looking out for. And it does highlight the fact that from a jobs perspective, there are significant concerns that remain in play. The directory or the direction of travel for US rates remains towards the downside, but a more patient approach expected for the year ahead. However, the toss-up at the moment is between whether we see a rate cut in March or April. Currently 52% chance of a pause in March. That means essentially markets don't know. So it could be March, and that's not necessarily too far away, because I know there's this sort of thinking that the Fed are done now. But certainly as things stand, markets are pricing a very good chance that they'll have one meeting off and then they're back at it again, easing once again to bring down borrowing costs. And so that's going to be a really interesting thing to drive market sentiment going forward. And of course, between inflation and the jobs data, you've got both sides of the dual mandate faced by the Federal Reserve. So in terms of the implications for markets, this is one chart I wanted to show you, which is the relationship between the 2-year yield and the dollar index. Essentially, the 2-year yield will often track sentiment around where near-term rates are going to be, i.e. what the Federal Reserve is going to be doing. If they're expecting additional rate cuts, we're seeing weakness in terms of the US dollar. If you see a more hawkish tone, then you see a potential rebound for the US dollar. That in part highlights why we have seen some weakness coming into play in the immediate aftermath from that FOMC meeting, because people said it wasn't as much of a hawkish cut as had been anticipated. Let's just jump onto the chart itself. We can see here that the price action, if you look on the daily time frame, has seen this sort of double top formation coming into fruition. We break down, we rally up through that neckline, but then bearish engulfing candlestick formation and a potential bearish continuation coming into play. Of course, we've seen this playing out over the course of the beginning of Donald Trump's second stint at the White House. Now we've entered this consolidation phase. Markets really trying to gauge exactly what's what. But with the fact that they're now expanding the balance sheet once again, albeit at a very slow pace, that opens the door to further expansion down the line if we see the economy in trouble. And you've got the fact that essentially there's question marks around the independence of the Federal Reserve, with Jay Powell being booted out in May and Donald Trump likely trying to appoint someone that essentially is trying to drive rates below where the committee think it should be. And so if you see all the other central banks taking sane decisions, and you see the Federal Reserve taking decisions based on the fact that the guy running it is essentially appointed by Donald Trump, that provides the basis for major underperformance for the US dollar. So look, we've come into the top end of this range that's dominated for a good part of half a year now, and we've created this double top formation. That to me provides the basis for further downside to come in my mind. So watch out for the potential for further downside. In my mind, I think it's pretty likely, especially considering we're at the top end of this range. For the near-term swing high, you've got to look all the way back up at, we don't want it in percent format, 99.3. So near-term gains, I think, are likely to be short-lived with the bears in charge for now on the dollar index. Then let's look at the S&P 500. A tentative move into record highs. That comes despite the fact that the tech sector has been under pressure after Oracle and Broadcom earnings. However, pulling back a little bit, I wouldn't be surprised to see this gradually grind higher as we move towards the back end of this year. I'm not necessarily expecting a collapse. And certainly if you're looking at the relationship between, say, the US 500 and the US 100, so the NASDAQ, let's look at that. So what we can see here is that we're seeing a resurgence in terms of the S&P 500 against the NASDAQ. So the tech sector losing a little bit of its shine at the moment, and people are looking for a more diversified portfolio because of the concerns around the AI bubble and the like. So I think when you're looking at markets in the US to do well, I'll be looking at the likes of the Dow, the likes of the S&P 500, which are a little bit more, it is more diversified compared to the tech-heavy NASDAQ. Pulling back at the moment, but we've got a 76.4 fib and the 68.11 swing low. As long as we don't break that level, the near-term pullbacks, I think, are all part of a gradual move towards the upside to continue this move higher. And finally, gold has been doing incredibly well. Ultimately, it's my highest conviction market because the justification for its strength just, I don't see how it goes away, quite frankly. The debt pile continues to build. The Federal Reserve are having to step in. The move away from long-dated bonds at the Treasury to short-dated T-bills and the like, as you're seeing this move from the Fed moving towards T-bill purchases. That's because essentially in the same way as if you're taking out a mortgage now and rates are elevated, you're probably going to take out short-term fixed mortgages. You might not lock in a 5-year, you'll probably lock in a 2-year and hope that in 2 years' time rates are better. So the US is constantly putting everything on the short term. It just means that there's a bigger and bigger pile of debt that needs renewing over and over and over again while they try and drive down yields. What happens if yields don't go towards the downside? Because we have a massive supply that needs to be constantly rolled over. They're in a bit of a sticky situation. We're continuing to see gold moving towards the upside. People are questioning the fiscal stability of the US right now, and the US isn't the only ones in that same position. And so we've seen this sort of gradual move higher. Now we've seen that break towards the upside. Certainly record high territory is within sight here. Similar kind of story for silver. And if we do see data coming out that is weak on the economic side and points us in the direction of additional easing from the Federal Reserve, that just puts more fuel on the fire. A breakdown below 41.74 would be required to negate this trend that's now back in play here following that breather that we saw at the back end of October in gold. I hope that's been useful. Make sure to like, subscribe, and follow for more. My name's Josh Mahony, Chief Market Analyst at Scope Markets.